Good morning, everybody, and thanks for joining us for the March edition of The Balanced Perspective. As always, I am your host, David Levinson of Net Group Investments, and we're joined on the line by Ian Power, the CIO of Truffle Asset Management. Ian, thanks so much for joining us. These months seem to come thick and fast, don't they?
Yeah, that's right, David. Morning to you and morning to everyone who's joining on the call.
So 2 weeks ago, when I pieced together the topic for today's discussion, the world was in quite a different place. And I think we would be amiss not to address the current situation unfolding in Ukraine. As the old adage goes, there are three sides to every story, your side, my side, and the truth. So I peeled myself away from CNN, BBC, and Sky News to Channel 407 or Russia Today to try and get an ounce of perspective from the other side. The wheels in motion of the propaganda machine are moving quite swiftly there, and I found myself unable to justify the actions that Moscow and Putin are taking. It's also quite a warped notion, the idea of profiteering from war, but I think it is merited today to understand how these events might shape our investments and, importantly, the concept of preservation of capital. So I'd like to bring in Ian here. Ian, so there was an article yesterday on CityWire, and I need to quote this correctly, where various managers provided their views around the crisis, and there were some quite stark comments. So one manager said that we are not adjusting our portfolio because of the invasion of Ukraine. We do not believe in opportunistically taking short-term tactical positions, while another said we are constantly monitoring and making adjustments to our portfolios as new facts come to light and opportunities present themselves. And I guess not to say that either approach is right or wrong, but what do you think is pragmatic and responsible given the events as they unfold?
So, David, I think the reality is that the situation in terms of, European recovery and the European geopolitical risk premium that's been priced into assets is changing. And I think, to ignore that, one would be naive and silly. And, even if you're a bottom-up investor and like we are, we focus on the company fundamentals, I guess the reality is that you've got a situation here where, the peacetime in Europe has changed to the extent of Russia taking quite a direct and aggressive approach in terms of what it wants to do with Ukraine and perhaps some of the other previous Soviet states. And I think this has implications for, energy prices, which we are seeing now skyrocket, access to various commodities. Ukraine is a big producer of agricultural products, wheat, etc. And, we're seeing a lot of these prices spike. So I think what it's going to do is it's going to take a bite out of consumption expenditure to the extent that you've got, higher prices that consumers are going to have to pay for, either gas at the tank and or energy. And then secondly, it's just going to add further fuel to this inflation fire that we've seen because of the COVID pandemic and the subsequent supply chain issues. So I think what it means for a portfolio is that, we're likely to see, further pricing pressure across the commodity chain. And I think the risks to growth, certainly from a European context, are starting to now move down. So in other words, the recovery, we still think, that Europe will grow, and this is not enough to sort of jeopardize that, but anything could change. And I think it's that new piece of information that investors need to digest and think about the positioning of their portfolios, and I guess think about some of those tail risks which perhaps 3 or 4 weeks ago people would have put a very low probability on, and today probabilities of those sort of tail risks have risen. So I think that means that one needs to always reevaluate your position in light of new information and new facts. And I think it just means that if there are changes that you have to make, you make them. But I think lots of those changes today are really because of risks that are ratcheting up fairly quickly, and what those risks could mean for growth, for energy prices, for peace, consumer sentiment. All of those deltas are looking fairly negative at the moment.
Thanks very much, Ian. Sorry, that was quite a tricky question off the bat there. I think when you start talking about politics, it does become quite philosophical as well. So last month we spoke about commodities, and the conflict you mentioned has added upward pressure here. I think oil going over $100. PGM basket, I think mainly palladium, has actually shot up recently as well. You mentioned wheat. I think Russia and Ukraine are something like maybe even a third of the world's wheat, or at least the biggest exporter, net exporter of wheat. So I guess a lot of this downward pressure on equities going into the crisis, which you mentioned already as well, was based on what the rate cycle was doing as well, as the hawkish comments coming out of the Fed, for example. But given what's happening around this conflict, what we're seeing in these increased commodity prices, but the Fed, and I've read certain articles around this, may not hike as aggressively as once perceived, and the yield curve may be reflecting this to a degree. Has this conflict changed your view in terms of inflation and what interest rates might do around the world?
No, so I don't think it's changed it in terms of inflation. If anything, it's adding upward momentum to inflation, or to those inflationary pressures, and it remains to be seen how permanent they are. But one would think that if we were sitting in the government of Germany, one of our biggest priorities would be to reduce our reliance on Russian energy, so that we're not in this position. And I'm pretty sure every single European country who imports gas will be looking to do that. And that is going to mean that there is going to be changes taking place in those economies, whether it's building more natural gas power stations or facilities to deal with imports and reduce that reliance on Russian imports. It's going to mean that energy prices certainly are likely to remain higher for longer, and the knock-on effect from the higher energy prices down the logistics curve into fertilizers. I mean, another a product of this is, Russia exports a lot of fertilizers to the rest of the world, and that's now obviously also under pressure. So it means agricultural prices are likely to be higher, and this just further fuels what we had from the COVID supply chain, which was the supply chain shock of higher prices. So I think what it means is, maybe the inflation picture remains uglier for a little bit longer. But because of the concerns about growth, you might see some of the central banks, particularly in Europe, perhaps maybe be a little bit less aggressive in terms of jacking up rates, because of some of the uncertainties that they're dealing with and the fluidity of the situation. So, once consumers are faced with rapidly spiraling prices for food, energy, that effectively is going to reduce their discretionary income and reduce the potential for that economic recovery. And hence, central bankers will try and build that into their positioning. But, the reality is that this inflation surge is coming through the chain, and this is just going to add a little bit more fuel to the fire. And I think yield curves flattening are, trying to price in the potential for sort of slower growth. And one is not saying that we're going into a stagflationary environment yet, but I think the probability of that has certainly gone up. Maybe it was 5%, maybe it's now 10%. But so I think it's going to take a bite out of global GDP. Higher energy prices will reduce global GDP, and I think in Europe, where they are obviously also having to pay higher utility prices, that's going to dent that recovery even more so than it would perhaps in a country like the US.
Thanks, Ian. Sorry, I'm scribbling away as you chat here. I know we're going a little bit off-piece in our discussion this week. We couldn't really prepare like we do for previous chats. But it is not difficult to link, I guess, the Ukraine crisis to our original topic, which was around supply chain constraints globally, with a strong focus on the semiconductor market. Would you say that as Europe, and you mentioned this, trying to diversify away from, I guess, Russian fossil fuel style energy to something like, and we mentioned this in the invite of the event, electric vehicles or EVs, wind turbines use semiconductors as well. I mean, do you see this as accelerating that move? I mean, particularly as you mentioned, Germany, I think, is something like 40% or if not more than that reliant on Russian gas.
Yeah, I think the reality of what we're seeing right now is going to mean that every European country will be looking for alternate energy sources. But I think, maybe not so much renewables to the extent that they just need to find a replacement. And I think we're already seeing, a lot of the governments talking about natural gas-fired power stations, which, yes, it is cleaner, but it is not renewable. But I think at the moment, what they're really trying to do is just to ensure that they don't have a situation where if Russia had to turn off the gas, that you would cripple the European economy. So I think that's sort of the first prize for them right now. It's what we would be doing. But I think it will push the sustainable agenda and push investors as well as, I guess, governments to accelerate, building out infrastructures, building out some of those networks so that they don't sit in this position in the next sort of 5 years. So I think that's really going to push more demand on a lot of the green metals. It is going to perhaps in the short term release some of the pricing or I guess some of the pressures on fossil fuels to the extent that, governments will be happy to have some coal-fired power stations right now as they then try and diversify away from Russia. So maybe it means that coal prices are higher for longer. And to the extent that countries have to fill the gaps with natural gas until the sustainable grids and power stations are built. Maybe that's the sort of scenario that we're looking at. But basically, it means that it's going to accelerate demand for lots of those commodities which are necessary in the build-out of that chain.
Yeah, I think, the local equity market also gives some sort of indication or lens into some of these risks that you spoke about and opportunities. I think Sasol's continuing a decent run. You spoke about liquefied natural gas earlier. All the PGM stocks seem to have had quite an interesting week in the last week. They've continued their positive trend over the course of the year. So the top of my head, I know banks also have done quite nicely in South Africa in terms of where the interest rate cycle might be. But generally across the board, there was obviously the big risk-off sentiment that hurt emerging markets in South Africa locally last week. I think some of those gains were paired on Friday. And similarly, you see that same trend in the rand as it's sort of tracking against the dollar. I have one more question, and this is maybe a little bit also again off-piece to what we've been discussing, and I think is maybe a little bit material. I haven't shared this with you before today, but it has been gazetted around upping the allocation of your Reg 28 pension fund in South Africa to increase a little bit more offshore, I think to the tune of about 45%. So that's taking, I believe, going from 35 or 40 to 45, no longer requiring the 10% Africa. So you could essentially go 45% global. I imagine this would have an impact on some of the local counters as well as maybe even some of the local bonds as some of our Reg 28 start really taking up that 45% allocation. Is that a fair comment?
I think that's right. I think over time you will then see investors move more of that allocation offshore. I think ironically at the moment is you've had a situation where offshore equities have been fairly fully priced vis-a-vis local equities. So tactically the opportunities in the SA universe looking fairly compelling, and South Africa also having quite a big value commodity weighting in terms of our index. I think also positive to the extent that many of those shares looking fairly decently priced. So I think short term, lots of opportunities domestically in a world where foreign equities are perhaps not that cheap. But I think long term, strategically, it would clearly make sense for investors over time to have more diversity, more exposure to other economies, other sectors, industries which we don't have in South Africa. And that must then take away from the local opportunity set, or certainly the amount of money invested in the local opportunity set. But for now, a lot of still decent value in SA, and SA looks pretty cheap, and certainly also pretty safer than some of these countries around the world, particularly in Europe, where we've seen quite a vicious reaction to the events that have unfolded over the last 10 days or so.
Brilliant. I believe we are out of time. Thanks as always for your comments today, Ian. Really do appreciate your time today.
Thanks, David, and thanks to everyone who joined this morning.
So just to recap some of the high-level comments from this morning, the European risk premium is, of course, changing as events unfold in Ukraine and Eastern Europe, for that matter. The conflict has had a material impact on commodity prices, as we'll start to feel at the petrol pump in the near future. And this has added further fuel to the inflation pressure, which I think, as Ian alluded to, will take a bite out of global GDP. Germany and Europe are looking to diversify, at least substitute away from Russian energy dependence, which could potentially be a tailwind for sustainable energy and battery storage technologies. The Regulation 28 changes that were gazetted yesterday would bring further opportunity set for the local Reg 28 investors, but as Ian mentions, the value still remains attractive for South African assets, as well as South African assets being relatively safe in the context of where the world is at the moment. So a very quick recap from myself, and Ian, thanks again for joining us this morning, and we'll catch up with you in a month's time. Take care.